Can we start? Okay. For this mock exercise, we're going to take a look at the consolidation process and how difference in ownership issue affects the consolidation. And we're going to take a look at Regent Corporations as an example. So let's take a look at the question. So we've got a company called Regent, and on December 31st, year 5, they prepared the reconciliation of the CBLO in preparation for the consolidated financial statement. So what I like to do is I like to highlight the fact that this is December 31st, year 5. I also like to note the relationship, and Regent in this case is the parent, and Argyle is the investment, is the subsidiary. You've got an investment in Argyle under the equity method, and then what they've done is they've taken a look at the shareholders' equity of Argyle, and that is $225,000. That's a shareholders' equity at December 31st, year 5. We're taking 90% of that to determine the unamortized acquisition differential at year 5. And then we're adding, and because that represents 90%, so we know that's a 90% ownership purchased, and that represents 90, then that means that the non-controlling interest, unamortized, their proportionate share is 10%, and that's $12,500. So the total unamortized acquisition differential is $125. And we've seen this reconciliation before in previous mock exercises on consolidation, where we try to prove the unamortized acquisition differential at any given point in time in the future. So we've actually seen this type of analysis before. Now, in this question, they gave us this, so we don't have to do the traditional calculate the acquisition differential and calculate the allocation of the acquisition differential to get goodwill. We've seen that a lot. We've done a lot of those already, but this question gave us the acquisition differential. And we're told that the 125 at 100% is allocated to land, equipment, and trademark. And you can see that there's remaining life of 8 years and 10 years. So we're going to need that information. These are the additional information for Argyle. It says on December 31st, year 6, which is the following year, Argyle reported net income. So I'll put down A, reported net income for 2000 in year 6, 50,000, and dividends of 20K. And we're told that the income is earned evenly throughout the year. And that's going to be important because you'll see in a minute that there are a bunch of acquisitions and dispositions changing the percentage of ownership of Regent over 2006 or year 6. You'll see that the first change is April 1st. And here, Argyle issued an extra 2,000 common shares at $75 each, and Regent did not participate, which means that Regent's ownership will decrease. Now, what happens is on October 1st, year 6, because the market price of Argyle's common shares have fallen, Regent turned around and purchased 1,300 shares of Argyle on the open market at $60. So again, Regent's ownership at this stage, so that's an important date as well, R's ownership increased. So we need to be able to account for that. Now, if you think about what's going on, is that at the end of year 5, we already have 90% ownership. So what we want to be able to assess is whether Regent continues to control Argyle through the decrease in ownership on April 1st and an increase in October 1st. So we want to be able to do that because it's going to matter how we're going to approach the acquisition differential and how we're going to record our proportionate share of Argyle's income as we prepare the consolidation process. And it says here the decline in value is not believed to be permanent, and any acquisition differential was allocated 20% of land, 35% of equipment, and 45% of trademark, which is kind of what they've done there. Okay, so the first part of the required asks us to prepare the acquisition differential amortization schedule for year 6, showing essentially 2 columns, controlling and non-controlling interest shares of the changes that occurred during the year. So it's looking for the amortization schedule of the acquisition differential, but what's important is we're going to take a look at the adjustments that we need to make to the controlling and non-controlling interest in year 6. For part B, it's asking us to calculate the equity method balance in the investment in Argyle's account at the end of the year. And what we're going to do is we're going to reconcile the Argyle shareholders' equity to the unamortized acquisition differential, much similar to what they did up here in the question, except we're doing this for year 5. So it's a very complex question, I will admit to you, and you'll see in a minute the puts and takes of the analysis. Now, before we get into the meat of the question, I thought we would kind of circle back on the lecture notes for this, and you'll see that it's important for us to know the process in how we account for ownership changes. So normally what happens is the parent will often buy an ownership of another company, and the first set of purchases you need to assess whether how to account for that investment. And oftentimes, parent will start with a very small percentage. And you'll see that in the first part, you need to be able to assess what type of investment we have, particularly if you don't have significant influence. So it goes back to your investment accounting. So here, when the parent buys a small percentage without significant influence, oftentimes it's recorded as either available for sale investment or fair value through P&L, depending on which investment standards we're going to use. And of course, we're going to record it at the price paid for those shares and adjust it through fair value through other comprehensive income at the end of the year if we're assuming it's a fair value, it's available for sale. If it's fair value through P&L, any other adjustments to fair value is recorded as part of regular income. So again, I just assume it's fair. In this lecture notes, we assume that we classify them as available for sale investment. Now, after the first increase in ownership, called block acquisition or step purchase, that resulted in significant influence, the equity method is used to account for the investment. And when we use the equity method, we need to calculate the acquisition differential. And we do that because we need to adjust the income that we, on the equity method, for any fair value amortization. And we've seen this. We've done this in previous mock exercises. So what we do is we for calculation, the amount that we paid should equal the carrying value of the previous purchase and the cost of the current purchase. So the key here is that, let's say the first purchase was 2% and the second purchase is 3%. You start to see that we build up these percentages, and as we build them, we're either going to use fair value through P&L or available for sale investment. Okay, so you have two choices essentially. And of course, you would add all of those amounts for different share acquisition. But as soon as you cross that significant influence, which is plus 20% ownership, then what we're going to do is we're going to calculate the cost of all of the carrying values of the previous purchases and the cost of the current purchase, and this is going to be what you're going to use as the investment. And then that's what you're going to use to calculate the difference between that and the book value of the investee to calculate the acquisition differential. Now, for each subsequent purchase and subsequent increase of significant influence that does not result in a control, what we need to do is we need to calculate a separate AD based on the cost paid. So essentially what we need to do is we need to calculate a separate AD on each portion. And that's what I've got here. So this is a good example of that. And this example is in your textbook. And you'll see that we have our second step purchase and our third step. And what we do is we keep the AD separate for each purchase. So we need to segregate the AD and the AD amortization separately for each purchase. And that's only when we still have significant influence. That's the key. So it's only for significant influence. Okay, so you'll see that in our second purchase, and this is just an example, and you really don't need to know the case facts for this example, but I wanted to highlight for you that in the second step, you'll see that we've allocated the AD between equipment and goodwill, and then we amortize it, and we have obviously the unamortized AD, acquisition differential, and then the third step, we're going to add to that. And of course, we amortize the equipment AD, acquisition differential, and goodwill impairment testing separately for each step of the purchase. So that is still a significant influence. Now, once control is obtained, IFRS 3 requires the investment to be adjusted at fair value on that date. So what happens then is that we're going to add all the various costs of purchase, and then at that point where we establish the over 50%, we're going to fair value the entire value of the investment. And then the resulting gain or loss associated with, if you compare the investment under the equity method on the books of the investor, compare that to the fair value at the point in which they achieve control, any gains or losses are recorded in OCI from the investment. Okay. And of course, it becomes part of regular income once we start disposing of our proportionate share of that investment. And what you do is we're going to replace any previous purchase allocation or AD allocation with the new purchase allocation. So in other words, you're going to take a look at all the acquisition differential amortization. We're going to get rid of all those previous ones that were done under the second significant influence level. And we're going to actually calculate it. And this is similar to the other mock exercise that we've done. Then we begin to consolidate and do not adjust any subsequent adjust the investment to any fair value changes to the shares. So for additional acquisitions that occur after control has been obtained, so let's say on the fourth acquisition we've got control, but on the fifth, let's say we got 60, and then on the fifth we bought another 10%. What the handbook requires us to do is not to calculate a separate AD, but treat the acquisition, the extra 10% from 60 to 70, as a transfer of equity from non-controlling interest to the parent with the following calculation. So this is what we're going to do with Regent. Regent and Argyle question is what we're going to do is we're going to take a look at the balance sheet non-controlling interest prior to the acquisition, multiply the portion of it that's sold to the parent, and that's the amount that we're going to transfer from non-controlling to the parent. In this case, in the first one, in April, Regent actually divested or Argyle issued more shares and Regent did not participate. So in this case, it would be a transfer from parent to non-controlling interest on April. But the second set of transactions in October, you'll see that in this case, it will be non-controlling interest transferring portions of their the portions of the amount to the parent. So if the cost of the step acquisition is greater than the amount of the transfer from the NCI, then the difference is going to be a gain or loss that's going to be reflected in the consolidated retained earnings. We're going to actually do that quick calculation for this question. Now, shares repurchased and canceled by the subsidiary, which results in an increase in parent's ownership, are recorded in the same manner as a direct acquisition by the parent after the controls have been obtained. So in our question, you'll see that on April 6th, Argyle issued 2,000 in which Regent did not acquire. So this is an example of that. So this is an example where the subsidiary increased or sold more shares in which parent did not participate. We're going to treat that the same as if the parent turned around and sold some of their share ownership. So we're going to actually treat it the same way, and we're going to see that also in this question. Now, under either a direct or indirect decrease in ownership, the parent's portion of the unamortized AD must be reduced by the percentage of its investment that the parent has disposed of and transferred the NCI share of unamortized AD. So direct decrease, parent sells shares on its own. Indirect decrease, subsidiary issues additional new shares and sells them to the third party, thereby diluting the parent's ownership. And this is the one that, this is really the Regent question. Just an example of the Regent question. Okay, so this is the one that we're going to focus on. But it should be no different whether it's a direct increase of the parent sold or whether the Argyle issued shares in which the parent did not participate. So what we need to do, once that happens, we need to calculate a gain or loss. And that gain or loss is computed as the difference between the proceeds received from either direct from a third party or indirectly. So it's the same, share proceeds received by the subsidiary and the net book value under the equity method. So this is the investment under the equity method. And that gain or loss is reflected, is going to be part of the consolidated retained earnings statement. Okay. And this is an example of what we're going to do today. We're going to actually take the, so you'll see that before the actual sale, we had a 90% and non-controlling had 10%. And these are the acquisition differential, the AD. And you'll see that once because we still control it, all we're doing is we're transferring the acquisition differential unamortized to the to the non-controlling interest. In this case, we're taking 9% off and giving it to the non-controlling interest. Okay, so we're going to actually do that simple example. Okay, so why don't we get started with answering the question. Okay, so in year 5, we need to determine the percentage of ownership. Okay, so I want to make sure you got the thing going there. Okay, so December 31st, year 5, Regent owns 90%. And how many shares are outstanding? There's 8,000 shares. So 8,000 common shares of Argyle. So I'll just put down the word A for Argyle, and that gives me 7,200 shares. Okay, so 7,200 shares is what Regent owns, And of course, the 800 shares is the non-controlling interest. So this is R and NCI. Now, on April 1st, year 6, 2,000 shares were issued by A. Okay, by A company. So what happens is Regent, R's percentage, is now 7,200 divided by 8,000 plus 2,000. So now Regent's percentage ownership is 72%. So what I want to do is I want to calculate what percentage did Regent dispose by not participating. So the ownership before, and this is Regent's only, was 90. Ownership after, and this is April, right? So I want to just highlight April. And this is December. So in April, you'll see that after, we now own 72%. So the difference is 18%. So the percentage of reduction of ownership is 18 divided by 90% gives me 20% reduction. And that's an important number. That's an important calculation that we're going to use as we answer the rest of the question. Now, I want to deal with October 1st, year 6. So this is now October, and what happened in October is we've got Regent acquires 1,300 shares in the open market, right? 1,300 shares in the open market. So what happens then is Regent's percentage is now remember we had 7,200, right, plus 1,300 divided by 10,000 shares. That gives us 8,500 divided by 10,000, or 85%. So again, percentage of increase in ownership is 85 minus 72%, that was before, divided by 72% gives me 15.29% increase ownership. And that's going to be very important for us to also note. So this is 20% decrease, 15% increase. Now, the other thing I want to point it out is how many months between December and April. So this is 3 months. And from April to October, so you've got April, May, June, July, August, September, that's 6 months. This is October 1st. Okay, it's going to be important because when we're calculating the goodwill, or sorry, the amortization of those acquisition differential, we're going to need to know how many months to amortize. Okay, so let's move on to the next part of the question. So we're told that the acquisition differential had land, so I'm going to write down the column here, land, and the balance on December 31st, year 5, we had a balance of 28,333. Then we've got equipment. And the balance of and this is the AD, right? We're dealing with the AD, the acquisition differential. The equipment is 44,444. And you've got trademark. And the balance there is 52,223. And you've got your total. Now, where am I getting these numbers? These are the numbers that we were provided in the question, right? These were the numbers from land, equipment, and trademark. And I'd just like to put the word 8 years here. This is the amortization, and this is 10 years. Amortization. Okay? Now, the total of this gives us 125,000, which we know is the total of the AD. Now, how much goes to Regent? Well, we know at this point it's 112,500. And how much goes to NCI? We're told that was 12,500. Okay. Now, we're going to amortize this acquisition differential before we get to the April 1st. So, let me write that down. Amortization from January 1st to April 1st. How many months is that? We said it was 3 months, right? So land, there's no amortization, as you all know. Equipment, we're going to take 44,444 divided by 8 years. That gives you the per year times 3 over 12. And that gives us 1,389. I'm just rounding it up. Trademark, the same thing. It's 52,223 divided by 10 years times 3 over 12 gives us 1,305. The total amortization is 2,694. And how much of that is, right, is Regent? Well, it's going to be 90% of that, which is 2,425. And 10% is 269. So the balance is 28,333. This is now 43,055. Trademark is 59,118. The total should be the sum of these three too as well. 122,306. And the remaining AD is 110,075. And this one is 12231. And it's important to have this knowledge because as we did in the question, you're able to figure out, and you can also figure out the investment in Argot under the equity method by applying the same concept in this question. So it's important to know what is the remaining unamortized AD and how much of that belongs to the parent Regent and how much belongs to the non-controlling interest. Now here's what happens. So we know that on April 1st they sold 20%. We saw that in our first calculation. So we're going to say April 1st, 20% sold to NCI. So we're going to take 20% sold to NCI. So 20% of 110,075 times 20% gives us 22,000. Sorry, 22. So 20% of this gives me 22,015. I'm going to take it away from the non-controlling interest Regent, from Regent, the parent. I'm going to give that to the non-controlling interest. Why? Well, because we still have control. Remember in our mini lecture notes, we know that we still have control, and All it is that if parent, a regent, decrease its controlling shareholding by 20% from 90 to 72%, we're not revaluing the entire business because we have control, and all we're doing is we're shifting the values to the non-controlling interest. So in this case, right, that's what's going to happen. Now, we're going to amortize the acquisition differential from April 1 to October 1, and that was for 6 months. So again, we're going to take the 44,444 divided by 8 years times, right? In this case, how many months? That's 6 months. 6 over 12. That would give us 2778. And the same thing for trademark. So the total of this is 5389. And how much of that belongs to Regent? In this case, what percentage of ownership do we have? On October 1st, we owned 85% of 85% of this number, which is 3880. And then that means that the remaining 15% goes to 1509. Okay, so now we need to know the balance. This is the AD as of 4/1, so we need to know the AD as of October 1. Just 40,000. This one is 48,000. And the total is 116,917. And when we add this all up, you get 84,180. And this one is 32,737. Okay. So now we need to amortize on October 1st, so what happened on October 1st? We acquired 1,300, so our ownership went up by 85%. So we need to be able to, again, take 85%, okay, which means that the actual sale was 15.29%. So we're going to take 15.29% of this total amount, and we're going to allocate it we're going to add it to Regent. So this is the October 1st increase, okay? And so this is the 15.29% increase ownership. So we're going to take that and we're going to multiply that, and we get 15,200, and we're taking 15,200 there. Okay, now we're going to amortize the AD for the rest of the year, which is from October, November, December, so 3 months. And the amortization is So again, now we've got 85% of this belongs to R, Regent, and then 15% of that goes to non-controlling interest. And this is the December 31st, year 6, AD. Okay? So that basically answers the first question. The first question says, prepare an acquisition differential amortization schedule for year 6 while showing the controlling and non-controlling interest changes in share ownership. That's exactly what we've done. So let me recap. We start with the acquisition differential beginning balance at the end of year 5. Then what we do is we first amortize prior to the actual 20% sale on April 1st. So we amortize it just like we normally would. And now when we take the 20% ownership, you'll see that we take 20% of the total and we're going to allocate it out of Regent and then into non-controlling interest. Okay, and then before the next event, you'll see that the amortization, we need to amortize it for 6 months. And you'll see that that's what we're doing here. We're taking the 444 divided by 8 years, which is what we said, times 6 over 12. Okay, and then we have to calculate the acquisition differential, the total, and how much of it is Regent and how much of that is non-controlling interest. Then the second is we bought 1,300 shares in the open market, increasing our ownership by 15.29%. Now we own 85%. So we went from 90 to 72 to 85. And then again, we need to figure out how much of that is related as a transfer from non-controlling interest to controlling interest, and then we amortize for the remaining period. Okay, so that's really answering part A. Part B, we're going to start calculating part B. And part B asked us to calculate the equity method balance. Equity method balance, balance in the investment in Argyle. So let's do that. So let's have a 2 columns, Regent and non-controlling interest. And let's start with the investment balance at December 31st, year 5. And we want to start with the shareholders' equity, right? Shareholders' equity of Argyle was 225 plus the unamortized 80 was 125 to give us 350. So this is the investment under the equity method, and we're going to allocate that to Regent at 90%, and at 10% is 35,000. Now, how did I get these numbers? This was the shareholders' equity of Argyle in the question, and this is the AD, okay, the total AD. So remember, we can always get to the equity method investment or the unamortized AD based on that relationship. Now, we're going to add the net income. Now, we're told that net income was $50,000 and it was earned evenly throughout the year. So we're going to only do it for how many months? For 3 months, right? Because that was April 1st. So times 3 over 12. and this is times 90% would be 80, and this is only for 3 months, ending April 1st. And that is 11,250. Now remember, we had AD amortization, right? And that AD amortization we did, and I'm just going to highlight what we need in this question. So we need these two. So this has got to go into the amortization. So 2425, 269. Okay, now this is the investment at April 1st. Okay, now Argyle issued shares. And it's 20%. Remember, we had a reduction of 20% of 323,825 is 64,765. So all we're going to do is we're going to transfer it from controlling to non-controlling. We're not revaluing the business because we still have control. Now, the new shares is 2,000 times 75%, $75, sorry. That was the issuance price, is 150. Now, how much of that do we now own? So remember, in our lecture notes, we said this would have been an indirect disposition, an example of an indirect decrease in ownership. And this time we only own 72%. And that gives us 108. Now, we need to add the net income, again, from April 1st to October, which is 6 months, October 1st. And this time we're going to multiply this by 72%. Because that's my ownership now for Regent. Remember the AD? The AD amortization, we needed that too as well. And the AD amortization is the 3880 and the 1509. Now, this is the investment. And this would be also the non-controlling interest on the balance sheet. Now, October 1st, we acquired, right? So we acquired acquisition from non-controlling interest. Okay? So it's a 148,237 times 13 over 28%. Okay? And the 13 would be the difference between the 85 and the 72% ownership. So this is really like 15.29% that we calculated. And that is just a transfer from the non-controlling interest to the controlling interest. Net income again, we're going to prorate. So remember, it was 50,000 times. Now the remaining months is 312 times 85%, because now we're at 85 at this point. And that gives us 10,625, and this is 1875. What about the AD? The AD amortization, we saw 2290 and 404. And then don't forget the dividends. Now, we're going to assume the dividends was declared at the end of the year, so now we own 85% of that, and that's 17,000. So quite a long reconciliation. And this is the December 31st, year 6, investment balance under the equity method. Now, I want to be able to prove that this is correct. And we're going to prove it based on that same analysis in the question. So remember this analysis? We're going to actually redo this based on, to make sure that the actual final number is correct. So the proof is, we've got the investment at December 31st, year 6, under the equity method. And that is 441,340, which is this number here. We just calculated that. Let's take the shareholders' equity, January 1st, 225. That was in the question. We added new shares. And that was 2,000 times 75. Okay, so we know that we added those new shares. That was on April 1st. Okay. We're going to add net income. All we're trying to do is figure out the shareholders' equity section of Argyle, right? And dividends to give us 405. Now we own 85% of that to give us 344,250. That difference of 97,090 should be the parent's portion of AD and amortized. Now, is that correct? Let's take a look. That should be this number here. So this agrees with part B. So that number equals that number. So I just want to put that side by side. Okay? That completes Regent question. Thank you.